Okay, we've just spent 10 minutes with all the three people that managed to come today, or bothered to come today, talking about what they knew about monetary policy. And as it turns out, three people probably know 80% of the whole course, what they should know a little bit more detail. So what we found out was that monetary policy is administered independently by the Reserve Bank of Australia. And they set the thing called a cash rate, which influences the interest rate. Now, what I'm going to go to in a while is to talk about the mechanism, the transition mechanism, that is the relationship between the cash rate and interest rate. Okay? But what we also found out that the main objective of what the Reserve Bank does is to counter inflation, which currently we found out is tracking very high at 5.6%, which is way above the inflation target of 2 to 3%. Right? The aim of this policy stance is called the contractionary monetary policy. The aim is to increase saving, which increases the leakage, and decrease spending, so we can have a bit of a turn off here. The aim is to have what we call a soft landing and not to have a recession, which you guys worked out was 2 negative quarters, so 6 months of negative economic growth. And that's what they're trying to avoid. The trouble with monetary policy is that there's always a time lag. So from the time that interest rates increase, and they've increased 11 times in the last 12 months, that we don't know until sometimes a year down the track the full impact, and that's what makes monetary policy a really difficult task or a tool or policy to try and predict. Now have a look at this cartoon here, right? Now it's fairly old, but it's certainly very relevant. Right? Here's the Reserve Bank and there's the economy, and he's using this club called interest rates. And it's a very good way of thinking about setting interest rate. It's a very inexact tool, right? So what we want to do, right? We don't want to just go tap with our club. If we don't tap too hard enough, it means that we're going to continue to be up here and inflation's going to remain high. The aim is to get inflation low. Right? So we get a club out and go whack, right? I'm sorry I'm picking on you, Nash, but you're the hostess. Right? If you go whack, it'll knock you out and you'll go into recession. Does that make sense? It's a really inexact science. Now, an assessment task that will be due next term, right, first probably end of week 1 and term 3, will be that you have to give an opinion of what you think the Reserve Bank should do. So it's a Reserve Bank role play, right? That'll come up. You'll be given that before you go away on holidays, so you can work on it. But we're doing all the preparation work this week. So that's a really good way of looking at monetary policy. Another one is this one. All right. And this is a bit confusing, but what it does, it highlights the phase of the economic cycle. Okay, cock-a-doodle-doo. Okay, this is looking at when there is more jobs. So we're going from down here up here. Okay, we're going in this direction here. So cock-a-doodle-doo, recovery means jobs. So as we go up here, more people are going to be employed, unemployment drops, right? Jobs, that means more spending. You guys know about that from the multiplier effect, okay? More spending means more consumption, right? More consumption, that means increased prices, right? So as we move up here, because inflation and unemployment are inversely related, you'll have inflation pressures rising, okay? They might be down at 2%, they might be sort of just going up towards the 3%, so that's still okay, right? Inflation, that means we have an overheated economy. Overheating means there's too much activity. And if it goes up too quickly, then we have inflation going over 3%. An overheated economy, high interest rates are certain. So that's what the Reserve Bank does. Right? In this scenario, we're currently in the phase that we're in relation to Australia. High interest rates mean jobs will be slashed. Guess what? That's terrible news. But what you've got to realise that this is what happens in the cycle. Right? And that might be 12, 24 months. Who knows? I don't really know. Right? But one thing the Reserve Bank governor has said, right, the guy that runs this joint, he said he wants an extra 200,000 people unemployed. That's what he wants. He hasn't said it exactly like I have, but in implication what he's saying, if he wants to get inflation under control, reduce saving, increase saving and restrict on spending, it means that some people have got to be out of a job. That's where we talk about cyclical unemployment. Does that make sense? Cool. Any questions? The other thing that you wanted to show you, and that's really important, that's in your book, but this is more up to date, right? In terms of where we're currently at. So as I was saying to you earlier, as economic students, you should know that the unemployment rate is 3.6%, inflation rate's 5.6%. That's really relevant stuff. That try and consume the news to an extent where you know that little bit of information. But here we've had interest rates, this is since 2012 I might add, they were at the current rate in 2012. We had this long period of really benign economic activity, which meant that the interest rates were decreased, and when we had this steep incline, that was during COVID, right? And now we've come out of it, but look at how steep we've come out of it, right? Another thing which you'll have to talk about and to process is the impact, right? We had the interest rate go up from 0.25%, cash rate from 0.25 is now at 4.1, right? Now in cold hard dollars, right? Say for example you're talking about say 4%. Say it's gone up by 4%, right? 4%, and an average loan in Launceston, I'm not talking about Melbourne or anywhere, might be 500,000. That's not really that high, right? But just imagine 4% on 500,000 is $20,000 worth of interest. So what that means is that if I've got a housing loan of $500,000, which is not that uncommon, there's lots with more, with higher mortgages, all of a sudden households have got to find an extra 20 grand, right? And that's what people are hurting. Now investors who've got investment properties, they say, oh, this is easy, I'm just going to pass it on to my renters. So that's why renters are really stretched at the moment. You may have heard about that. And people that are stretched or marginalised, where do they end up? If I can't pay the rent anymore, where do I end up? Homeless, on the streets. Or, God forbid, I might have to go and live, I might have to go and share with somebody. Or, even worse still, you might have to go and live back with your parents. I'm being silly there, but that's what's happening. But again, the Reserve Bank governor has said, that's probably a good thing. That's what he said. Anyway, I'm not having to go at the Reserve Bank governor, but it's just notable when he says those things, because they're the cold, harsh realities. Okay. How are we going so far? There's one technical thing that I have to talk to you about. Right? And I'll come back to this in here. When the Reserve Bank sets the cash rate, right, it takes a while for the actual interest rate to catch up, the interest rate in the finance markets to catch up with the actual cash rate. It takes a while, okay? So what I'm going to do, I'm going to show you a video. Yeah, that's right. I'm Now, the price of money is its interest rate. So if something's in short supply, you know you have to pay a higher price, right? Same with interest, right? So with the, does that make sense?
Yeah.
So usually have Q and dollars P, okay? But in the money market, and the banks, they go in there, superannuation funds, it's not us. Because we're talking about hundreds of millions of dollars. Yeah.
Also, if there's less money, meaning that more leakages, so like people, one of the ways is that people put more money into savings, and then if they increase their interest rates, that means banks have to pay more. Yeah, banks now spend more because people
Yeah.
saving more and interest rates are higher.
Yeah.
Isn't that bad for the banks then?
Well, no, the banks are always okay because they have this thing called a margin.
Okay.
Right? So the margin between what they give you as investors, so for example, you put a term deposit away and get 5%, for argument's sake. I don't think that's possible, but I'm just picking a number. Right? And if you come along and say, oh, I wouldn't want a mortgage loan, the margin to cover costs to make a profit is maybe 2% on top of that. So you'll get your mortgage loan at 7%, but I'm going to give you 5 or 4%. In actual fact, over the COVID times, the interest margin for banks has actually increased. The same as profit margins for a lot of businesses has increased. Right? They call it price gouging and priceflation or greedflation.
Who decides on that margin?
Well, it's a market economy, right? The banks have decided on that. Because there's not that much competition in the Australian banking market, they'll sort of do the same thing, right? There's a few of the lesser players that, you know, like Ubank and Bendigo Bank, they try to be a bit more aggressive, but they're such small players and therefore, you know, they don't have a big impact in terms of determining a lower rate. Okay, so when we talk about over here, we talk about the interest rate, and over here, we talk about the supply of money. Right? Now, I have to be very careful here because I remember doing this in my second year of economics, talking about money supply. So it's fairly simplistic, I'm going to show you. But you have to realise the relationship of when the cash rate goes up, and you've already identified that the interest rate will follow, but the supply of money goes down, right? This video hopefully will explain it to you, and then I'm going to explain it to you in more graphic details with this. Hopefully that'll work. And you'll have to tell me if you understand it or not. If not, I'll have to do more work. Okay? Alright, let's have a look. So this thing that you have to get your head around is called domestic market operations. Now this is American, but it's very useful for Australia as well. Now it'll be worthwhile to take some notes here if you like taking notes, and I'll stop quite often. So you talk about open market operations that influences the money supply. And if you understand this, you're home and hosed for monetary policy.
Term open market operations refers to a monetary policy tool in which central banks buy and sell bonds to regulate the money supply in the economy.
Okay. Now buy and sell bonds. Right? Bonds. Does anybody know what a term deposit is? If you take money to the bank and say, look, I'm going to put my money down, say $1,000 at 4% for 12 months. You're depositing your money for a term with a promise to get a repayment. Does that make sense? So when the interest rates go up, people are more attracted. Oh, I can earn 4% instead of 2%. It's going to incentivise me to keep money in, right? Now the same thing happens with big banks and financial institutions, right? Bonds are things issued by reserve banks and other governments. And the principle's the same, you know. here's 100 billion, or 100 million let's say. I'm going to put it down at the cash rate at currently 4.1% for 6 months, 12 months. Okay, that's a contract, I'll keep it there. And then I'm going to get, at the end of that term, right, I'm going to get my money. So 4% on 100 million is going to get $40,000 back. Okay? And that's what bonds are. They're financial assets where you put cash away, and it's usually put away with the Reserve Bank.
The United States employs open market operations through the Federal Reserve Bank. One of the Fed's goals is to limit inflation during periods of healthy economic growth. By reducing the economy's supply of funds, the bank puts the brakes on the economy if it's expanding too quickly. When the economy is more sluggish, its objectives may change. The Fed may, for instance, start pumping money into the economy until unemployment dips to a certain level. So how does a central bank like the Fed regulate the money supply?
Okay, so that's not telling you anything new so far, is it? So if the cycle is here, the Reserve Bank will pump money, or the Reserve Bank will pump money, and here they'll take it out. But how they do it, it's coming up.
One, to increase the money supply, the Fed will purchase bonds from banks. This increases the funds that banks can use as loans to individuals and businesses.
Okay. Purchase bonds. Alright. Keep going. And then it's probably easy to understand the selling
More
bonds.
cash in the banks results in lower short-term interest rates. And when borrowing costs are low, economic activity tends to rise. Conversely, if the Fed sells bonds to the banks, it takes money out of the system. This elevates short-term rates eventually.
Okay. So let's just focus on selling bonds, right? So when the cash rate, let's just do this one here, up here, right? If we're trying to contract the economy, right? We're trying to decrease the money supply. And what we do, we sell bonds. We, meaning the RBA, sells bonds. And this is where this model illustration will come in. Okay? Here's 100 million. Right? Now that's sitting in your bank box. Right? Now, I'm the RBA. Right? And I'm going to sell you a bond. Here it is. Right? It's got the logo on it. RBA of Australia. Right? 100 million at 4.1% for 6 months. Right? So this is a contract document. Right? Now, I know that Dinesh is keen to, he's attracted by the high interest rate, by the cash rate, right? So I'm going to sell him, on the Reserve Bank, I'm selling him this. What am I doing? I've sold a bond, and now there's only 200 million in the circulating, because this is in the Reserve Bank bankroll. Does that make sense?
Yep.
Yeah? Okay, and that's it's really as simple as that, right? Let's just go down the track. Now, if the interest rates, for example, if after the 6 months, do I do that for 6 months?
Yes.
Okay. The bond matures. Now Dinesh has got a decision to make. Will I keep it in the system? Well, okay. So will I keep my money with the Reserve Bank or take it out? Right? Let's assume that the interest rate goes in 3%. And he said, nah, not interested. 4% is good, 3% no. After that period of time, Dinesh says, I want my money back. Oh, I'm going to buy, Reserve Bank buys the bond, here's your cash, plus some extra because you earn interest. Yeah? Now, That goes in circulation. So you're a bank, you're then going to loan more loans out and that sort of stuff. Right? So that means that we're probably down here and we're in the expansionary phase. Right? So the buying and selling of bonds influences the money supply. And that's what this has just said. Right? Let's look at the rest of this.
Leading to reduced economic activity. The Fed's Federal Open Market Committee meets 8 times a year to reevaluate its strategy. Based on its outlook for growth and inflation, the committee may decide to increase interest rates through bond transactions, decrease them, or keep them unchanged.
Okay, that's exactly what the exercise that you're going to do later. As I said, you're going to get the assignment before the end of term. You're going to probably get some time in term 3, maybe a couple of lessons. I don't know. It's a fair way ahead. And then you will then have to say, well, the economy looks like this, right? And we've had all these interest rate increases. I think we should keep them high. Or you might say, well, we're not anywhere near the 2 to 3%. We need to keep raising interest rates. Right? In your answer, you'll have to realise the difficulty of going too soft or too hard. If you go too soft, inflation doesn't come down. If you go too hard, you club the poor fella senseless, the economy senseless, and you don't have a soft landing, you have a hard landing, and therefore you have a recession. Does that make sense? So you'll have to get your head around and prepare a report, and I think it's about 3 minutes normally. Right? And you have to talk about these are the graphs, just by telling me, and therefore I, based on all the information, think this. Then we look out to see what the next Reserve Bank meeting actually did and compare it to what we thought in class. So it's a fairly practical activity.
While banking practices vary from one country to another, numerous central banks around the world use open market operations for the same overall purpose. While the government can take other actions to influence commerce, securities trading is one of the quickest and most effective ways to control economic activity.
Okay, now securities trading are trading in bonds. Okay? They're those things that did I get it back? Oh, there it is. There's my bond. I got my bond back. Okay? Securities. That is a security. It secures you an income. I was going to get 4.1% after 6 months. Right? So I'm going to get about 21,000 or so, 22,000. Right. So that's that one. Now what I want you guys to do is to do the exciting stuff by going through the textbook, the end of, I don't know, it's 325. Can you please check that? Whether it is actually on page 325. It's the chapter review, the end of chapter 15. Textbook. But it's necessary. And those questions, they're like your notes. You've already taken some notes. Right? If you don't understand the stuff, write more. If it's sort of making sense, write less. But they form part of your notes, essentially. Alright? Alright? It's up to you guys.